Hi everyone, we are Group 6 and today we are presenting the Barrick Gold case. We are going to focus on Barrick's company overview, their gold hedging strategy, influence of hedging, and their future path. We are also going to discuss an interesting topic of similarities and difference between oil and gold with some general financial risk management. In 1983, Peter Monk, founder of Barrick Gold, acquired Renewable Gold Mine. Over the next few decades, Peter has acquired many other gold companies with Barrick stock, which made Barrick the world's largest gold company by 2006. Barrick Gold started their gold hedging strategy in 1993 that allowed the company to ensure a stable level of revenues for the next decade, given Barrick generates sufficient production from its gold reserves. In 2003, Barrick Gold started a non-hedging policy, and on September 24, 2009, they announced the elimination of its gold hedge book within 12 months and taking a $5.9 billion charge against earnings. New equity and new bonds were issued soon after this announcement. The share price closed at 39.30 cents following the news. By November 1, 2010, the share price closed at $48 per share. For Barrick Gold, the value proposition is selling gold at the best price to maximize value of shareholders. They have 5 major competitive advantages. First, high quality and diversified mine locations around the globe. Second, financial strength, large cash reserves and strong balance sheet. Third, diversified production portfolio, a handful of large gold projects across multiple operating mines. Fourth, low total cash production costs compared to peers. And the last but not least, better credit rating serves lower financing costs. Now I'm passing on to my teammate Eva.
Thank you, Iris. Next, I'm going to demonstrate how Barrick's gold hedging works using a simple example. So now let's imagine producer Barrick starts operating a new mine in Nevada today and enters a forward contract with Bullion Bank, promising to deliver 1 ounce of gold at the end of 5 years. The gold price today is $300 per ounce. Right after the contract is signed, Bullion Bank turns around and borrows same amount of gold for same number of years from central bank with lease rate of 2%. Bullion Bank will pay total amount of $31 at the end of lease, 5 years after today. After Bullion Bank receives gold, it sells the gold into spot market, receiving $300. Then it puts $300 from sales of gold into funding desk for 5 years, expecting to receive compounded interest of $83. After 5 years, funding desk is going to return $300 principal and $83 interest to Bullion Bank as promised. Bullion Bank is going to pay $345 to Barrick to buy 1 ounce of gold, and then return this 1 ounce of gold to central bank. In this process, Bullion Bank charges $7 in total. So why Barrick agrees with selling price of $345? It is the price of spot gold at the beginning of the contract plus the interest received from funding desk minus the lease paid to central bank minus the Bullion Bank's fee of $7. Hence, Barrick can charge the price of $345 in this forward contract. Next, I'm going to pass to Guangming to talk about influence of hedging.
Thank you, Eva. At the early stage of the company, Barrick was small in scale with unstable cash flows from concentrated operation in limited gold projects. Barrick has low risk appetite on the gold price volatility, especially a decrease in gold price, which would have big impact in Barrick's revenue, profit margins, and free cash flows. That would threaten Barrick's financial health and overall survivability. Hedging the gold price on future production stabilized the revenue stream and made the income and cash flow more predictable for the company to manage the working capital and capital expenditures. During 1990s, both low gold price and high interest rate made hedging very successful and profitable. Barrick grew into the world's largest gold producer by acquiring multiple gold projects with the additional revenue from the hedging program. Things started to change in 2003, both backwardation, when gold price rises over the forward price, and the low interest rate environment caused the hedging less effective and money losing. Because Barrick locked in 5-year forward contracts, it was slow to react and costly to get out from the contracts while the spot gold price kept increasing. By the end of 2007, there accumulated 4.6 billion unrealized loss on the hedge book, which concerned the overall market. However, by then, with stable cash flows from multiple gold products, large cash position, and various available funding sources, Barrick didn't need to solely rely on hedging program to provide financial management and risk management. Now, it is time to end the glorious premium gold sales program and start a more forward financial risk planning and management framework. Now over to Gainan to talk about future hedging paths.
Thank you, Guangming. Now let's take a look at their future path. Given the recent development of Barrick and also the economic environment, we believe that the company should employ a more comprehensive and a structured risk management framework. That includes defining a risk appetite statement. In that statement, the company should define the amount of risk to take in exchange for upside potentials. The management team should look at internal factors and also external factors when arriving at their risk appetite. The internal factors should include their cash reserves, the gold mines they have, the desired free cash flow levels, and also the line of credit made available by banks. For external factors, there are a lot of moving pieces. So that's why we recommend an in-house analytics team who will focus on the macroeconomic factors. Such factors might include the expected inflation, the PMI, investors' confidence and sentiment, foreign exchange, and also Fed announcements. All those factors might play a role in the price movement of the gold in the near future. After thorough analysis and discussions, the executive team should form an opinion regarding the trend of the price movement in the near future. Based on this trend and also their risk appetite, the management team should hedge the risk only beyond the risk appetite using various hedging strategies and instruments, such as partial hedging, Greek hedging, and cross hedging, and etc. On top of that, the firm can also employ early warning indicators to increase the hedging position only if the gold price moves unfavorably. For example, if the gold price decreases by 20% or more, the company can enter into more hedging positions to protect the downturn. All in all, they should also review the risk appetite statement and also their hedging positions to make sure that they are relevant and effective. This approach comes with benefits and risks. Now let's take a look at the benefits first. The first one is that this approach would utilize the firm's strong financial position to take appropriate risk and maintain the upside potential of gold prices at the same time. Without entering into a 100% hedge position, Barrick would be able to benefit from the upward movement of the gold price. The second one is that this approach clearly identifies the amount of risk the firm is unable to take and hedges accordingly. This will set the bottom line of the operation, and also it will guarantee a free cash flow for the firm. The last benefit is that the early warning indicators would give the company the option to hedge only if the price moves unfavorably. This is a real option to the management team, and they can choose to exercise it in the future, not as of today. On the risk side, we have 4. The first one is that this approach will incur more cost by building in-house analytics team. So this will have an impact on their net income. The second one is that the management's view relies heavily on their knowledge and experience. If their view is biased, this will have a very negative impact on their hedging effectiveness. The third one is that if the price moves unfavorably, it would be expensive to enter into a new hedging position by then because the expectation is priced in. The last one is that there will be volatility in future cash flows, so management might need to exercise extra caution when planning for large investments. Now, I will hand over to Jeffrey.
Thanks, Kainan. Now let's get back to the reality of 2021 and imagine we're an oil company with significant current and future undeveloped reserve. The past year has been one of the most volatile times for oil as price went to negative territory in April 2020. Going forward, we expect the oil industry to be highly challenging with continued volatility in oil prices for the next 20 years. From our presentation earlier, we know how Barrick has hedged its gold production in their favor to stabilize revenue and increase their bottom line. As an oil company facing high uncertainty, we can learn lessons from Barrick's hedging and use it to stabilize our revenue and reduce risk. Financially, both oil and gold are considered commodities, but gold is considered as an investment asset, where oil is for consumption and does not carry too much investment value. Both commodities can be hedged using future contracts and swaps, but gold has another channel of hedging through bullion bank. Economically, oil price typically has positive correlation with the economy as there is more oil demand during economic expansion. On the other hand, gold price has slightly negative correlation with the economy since gold is considered as safe haven when economy is turning south. In terms of operations, gold is easier to store as opposed to oil, which requires specialized storage facility. And assuming that we are not a state oil giant like Saudi Aramco, oil industry is more competitive than what Barrick faces in gold industry. Because of more demanding storage conditions, oil companies would sell the produced oil at almost any price to avoid high storage cost. Given the highly volatile nature of oil price and competitiveness of the industry, hedging is recommended to ensure stable earnings and continuous cash flow. The amount of production to be hedged is determined by company size, strength of our balance sheet, current oil price, economic cycle, and other factors. The duration of the hedge should be less than 5 years, as we learned from Barrick that having hedged production too long into the future may significantly undermine our profit and destroy shareholder value. One recommended hedging level is to have enough hedged production to ensure sufficient cash flow for continued operations. Not only oil industry can use hedging to protect profit and reduce risk, hedging in general can be used in various scenarios. Commodity producers can use futures and swaps price. Manufacturing firms can use futures to lock in lower raw material cost. Multinational companies can use currency swaps to fix foreign exchange rate and protect their earnings. Companies issuing bonds with variable interest rates based on LIBOR can use swaps to fix their interest payment and mitigate interest rate risk. In general, a company's decision on hedging is a trade-off between having price certainty and losing potential profit, or trading between having protection and the cost of hedging. Nonetheless, hedging is one of the most important risk management strategy for companies to mitigate risks. That concludes our presentation. Thanks for listening.